By now, you understand why savings is critical. However, you also understand that savings alone are insufficient because the returns tend to be poor and often fail to beat inflation. So, investing some part of your savings is essential, as investing can help fight inflation and earn attractive returns. Why investing? Think of investing like growing a tree. Once you start planting the seeds, it can take years for the tree to fully grow before it starts providing benefits in the form of flowers or fruits. Similarly, once you start investing, depending on the investments chosen, it can take a few or several years for your investments to meet your financial objectives. These could include funding for buying a home, funding for retirement years when there will be no income, etc. Prematurely selling your investments defeats the very purpose of purchasing them, which is to create wealth over the long term. Now that you know the why aspect of investing, let's talk about the where aspect. That is, the various investment avenues into which you could invest your savings. Where to invest? The assets in which you can invest could be broadly divided into two groups: physical assets and financial assets. Physical assets, such as real estate and gold, can be seen and have a physical presence. Financial assets, such as equities, fixed income instruments, and mutual funds, cannot be seen and exist only on paper. Meanwhile, how could you earn returns by investing? The returns you earn on investable assets could come in capital appreciation, periodic income, or both. Let's talk about a few examples. When you invest in gold, you only earn returns by way of capital appreciation, that is, an increase in the price of gold over your purchase price. When you invest in fixed income instruments, such as a bond or a bank fixed deposit, you typically earn returns in interest only. Fixed income instruments have a limited life. Once they mature, the amount you invested is returned to you. So what you earn is only by way of periodic income. On the other hand, when you invest in a real estate property, you can earn returns by capital appreciation and periodic income, which can come in the form of rent if you have let out the property. Similarly, when you invest in equities, you can earn returns by capital appreciation and periodic income, which can come in the form of dividends that companies pay to their shareholders. Now, a question that you might ask is, what avenue should I invest in? To be honest, there are many. The avenues you choose can vary depending on factors such as age, investment time horizon, risk tolerance, financial strength, etc. For example, let's assume that Rohan and Michael are looking for investment opportunities. Let's say that Rohan is a 30-year-old working professional, while Michael is just 5 years away from retirement. Given that both are in different stages of their life, their investment choices could vary. As Rohan is young and has a long working career ahead, he could be willing to take more risks because he has time on his side to recover from losses if he were to suffer one. As such, he might invest a more significant proportion of his investable money in riskier assets such as equities to earn attractive returns. On the other hand, as Michael is just 5 years away from retirement, he might not be open to taking higher risks. It is because if he suffered losses, the time to recover from those losses would be less. Hence, Michael might consider investing in safer assets such as medium-term bonds, fixed deposits, annuities, etc. What can we make out of this? Well, the investment avenues chosen can vary depending on various factors. Diversification. Let's now briefly talk about an important concept in investing: diversification. You must not invest money in only one asset. Why? Because by doing so, you could be taking an excess risk or too less a risk. For instance, if you invest your savings only in equities, you risk losing some of your invested money if the purchased stocks decline over time. Similarly, suppose you invest only in fixed income securities, then your money will be safeguarded, but the upside potential, which is the reward, would be limited. Also, all assets do not rise and fall at the same time. Depending on economic conditions, when one falls, another could rise and vice versa. For instance, riskier assets such as equities don't perform well when economic conditions weaken, while safer assets such as bonds and gold tend to perform well during such times. This is because investors tend to shift their money from riskier assets to safer ones during economic uncertainty. By diversifying your investments across assets, you would be taking steps to spread your risk. In this video, we talked about why to invest, briefly explained where to invest, and discussed the need to diversify. Let us conclude by now talking about the key takeaways. Investing takes time to reap benefits. So, it is essential to be patient and stay invested. Breaking investments too soon defeats the purpose of purchasing them. We could categorize investments into two groups: physical assets and financial assets. Returns earned on investment could come from capital appreciation, periodic income, or both. The avenues you choose to invest in can vary based on factors such as age, investment time horizon, risk tolerance, financial strength, etc. You must not invest in only one asset, but must do so in multiple assets, preferably 3 or more. By diversifying your investments across assets, you would take steps to spread out the risk of your investment portfolio. That was all we wanted to talk about in this video. We hope to see you in the following video, where we shall discuss equity as an investment avenue.